What's going on, everybody? In this episode of How to Trade, we're going to be talking about swing failure patterns, also known as sweeps, liquidity grabs, and stop hunts. I prefer to call them sweeps, so throughout this video, I will be calling them sweeps. So in this video, we will be looking at what to look for the pattern, the meaning behind the pattern, and how you can trade it. Preferably, I like to trade these on futures, typically ES and NASDAQ, but they can be traded on many different assets. Let's start off with what to look for. So the exact pattern, we need to see a prior candle's low or high, and then the next candle, we need to see it break that prior candle's low or high. Now, typically, if it is a bullish sweep, one on the low, going into a long trade, you want it to be a red candle turning into a green candle. Now, in this exact example, I have two green candles, which is okay, but typically these sweeps are going to be a red candle going into a green candle if it's a bullish sweep, and then a bearish sweep will be a green candle turning into a red candle on the following candle. The colors do not have to be exact, they just typically increase the strike rate by a little bit. Okay, so looking at the setup here, you need to have a prior candle's low. So in this case, we're using this candle right here. You need to mark out that candle's low. And then for the pattern to become a sweep, the following candle, the next candle after that, needs to break that candle's low, but it needs to fail to close below that level. So it needs to wick that level. So in this case, what is happening is we have that prior 30-minute low. The next 30-minute candle breaks that level. It breaks the low of that candle. The sellers are then trapped on the low of the wick, so they get bought up very quickly. The bears' stops are triggered on the sharp move up. So think about this. If you are shorting, how do you get out of the trade? If you are shorting to enter a trade, if you're selling to open the trade, that means you have to buy to close the trade. So all of these bears that traded the breakout of that prior 30-minute low, in this case it was low of day, they are now trapped on the low and they are negative. So in order to get out of their trade, they have to buy to get out. Now that could be market buying just to, if they're panicking and they want to get out of the trade immediately, or let's say they put in their stop losses above that candle's low, and then when those stop losses are triggered, that will close their trade. Once again, typically those are market orders. Now, for the buyers who want to trade this as a reversal trade, we typically want to enter when that wick is buying back up into that prior 30-minute low. So wherever that low's level is, once that wick starts to climb back up, we can see all that buy pressure starting to come in from those bears' stop losses being triggered. That is typically when we want to enter this trade. So as that wick is coming back up and breaking that prior 30-minute low, as long as there is a lot of bullish delta in that area, which typically means market orders, as long as we're seeing those bullish market orders come in and we are seeing strong candle closes, typically on the lower time frames, the 1 minute to 5 minute, whatever time frame you feel comfortable with, as long as we are seeing strong buying momentum back above that prior 30-minute low, we want to be a buyer and we want to follow those stop losses being triggered, because those stop losses are helping us on our trade. Like I said earlier, all of the breakout shorts here, think about it. If you're taking a breakout short, that means you are selling to open and placing your stop loss as a buy order. So when they are being trapped on the low and they are being pushed back up, they are getting scared and closing their positions, which means they are turning into buyers. So you have the shorts turning into buyers because they're closing their position, and then you have the buyers that are buying to open their positions like us because we want to trade that reversal. Now, what do you target on a reversal like this? Now, typically, as I talk about in my other videos, there are many different targets. You can target prior candles highs, you can target VWAP, you can target value levels. It really just depends on what levels you like to use in your trading. Now, typically, what I look for is when I enter a trade on a sweep, I would like to put my stop loss below the low where those sellers are trapped. Now, depending on how far away that is, sometimes you can't always do that. Sometimes you have to put your stop loss a little bit above that low. As long as your stop loss is below the 30-minute low that is being swept, that's that level that is being broken and then reclaimed. As long as your stop loss is below that level, I have it noted with that flat horizontal white line there. As long as your stop loss is below that level, you are typically fairly safe as long as that sweep is triggering enough stop losses. Now, like I said, typically you would want your stop loss to be below the low, but sometimes it's just too far away. So your stop loss is below the low or inside the wick, and then you are targeting prior levels. You are targeting VWAP, 30-minute highs, prior candles highs. Maybe that would be the daily. It could be volume profile levels, whatever you like to trade. Typically with these trades, because they are risky, you would want at least a 1.5 to 2.0 risk reward, meaning if you risk 5 points, you would typically want to make at least 7 to 10. And if you're risking 10, you would want to make 15 to 20. Okay. Okay, let me go over this one more time, and then we'll show a bunch of examples. So for a bullish sweep, we need to have a prior candle's low, so that candle needs to close. Then the following candle, the candle after that, needs to break that candle's low, but it needs to fail to close below that level. And it needs to push back up, causing a wick to retrace that prior candle's low. And then once it retraces, we want to take a trade on that level that is being wicked. Now, what I didn't say earlier, you can wait for that 30-minute candle to close if you would like confirmation. The problem with waiting for that candle to close sometimes is exactly in this example, sometimes it closes way too far away from where that sweep started. If it were to close just above that level that is being swept, let's say it closes right here where I have this arrow pointing, that would be an okay close. You would have to put your stop loss below that prior 30-minute low. You couldn't put it below the wick. It's just too far away. But typically, if the close is relatively close to that level that is being swept, you can wait for that close for confirmation to take that trade. But in most cases, depending on the volatility, you will probably have to take that sweep before the candle closes. Okay, so prior 30-minute low, broken, reclaimed, you enter the long, and then you look for that buy momentum to continue. Okay, for the bearish one, let's look at this candle up here. You see this big red candle here? It is sweeping this doji. So this doji, look at the prior high right there. The prior high is being broken by this upper wick, and then it's being retraced back to the downside. So if we wanted to scalp this as a short, once that prior candle's high has been broken, we wait for price to come back down, and as price is falling back through that level, we want to take a short. And then we want to place our stop loss above that high of that wick. Okay, so stop loss is above the high. Our entry is after that level is reclaimed. And then once again, your targets are whatever you like to target. Prior candles lows, VWAP, value levels, daily levels, whatever it may be. As long as you are getting at least a 1.5 to 2.0 risk to reward. Okay? All right, so that covered what to look for and the meaning behind the pattern. The meaning behind the pattern is basically stops are being triggered. Okay, so typically when you see 30-minute wicks happening Stop losses are being grabbed, liquidity is being grabbed, and then price is reversing. So the trend that is causing that break is actually not the real trend. So let's take these examples. So right here, let's say the sellers are breaking that low right there. The trend that is causing that breakdown is not the real trend. They are breaking that 30-minute low to grab liquidity for the uptrend. They actually want to push the price up, so they want to get their orders filled by triggering stop losses. Okay, it's a little bit deeper. We talk about this in the order flow playlist a little bit. I can't get into it too much in this video, but basically they just want to get their orders filled by triggering stop losses. So they can trigger a lot of stop losses by pushing the price down, getting people to enter trades, and then they are trapped. So on both sides, they can trigger stop losses. People who are longing here, their stop losses are being triggered by that lower wick. And then people who are shorting the breakout, their stop losses are being triggered on the bounce back up. So these moves are very dangerous for both sides. The buyers are being taken out and the sellers are being taken out. And that is exactly why we like to wait for that sweep. We do not like to trade this as a breakout. We like to trade this as a reversal. We want to wait for when those sellers are getting stopped out of their position. Okay? So long story short, the meaning behind the pattern is they want to grab liquidity, they want to stop people out, and they want to reverse that move. Okay? So we talked about how to trade it, but let's go into a few examples here. Now, this happens all the time on the 30 minutes. So as I'm going over these examples, you guys can probably find 20 more examples on my chart, but I picked out a few ones that should be fairly easy to understand. Okay, so for this bearish move here, we have a pretty strong trend to the upside, right? And then look at this candle close right here. It closes very strong. The high of that candle closes, and it looks like this trend is going to continue to the upside. Then the next candle, this candle right here, looks like it continues that trend. It pushes higher, but it fails to close above that prior candle's high. So as that wick comes back down and breaks that level, we want to take that as a short trade, okay? So we want to take the short as price is coming back down. Like I said, you can wait for the 30-minute close. Sometimes it's a little bit dangerous because it is far away and it gives you a wider stop loss. Obviously, in hindsight, this one would have been fine if you waited for the 30-minute close. So scalp entry is right there. You're entering short or you're entering here. So that's the aggressive entry. That is the conservative entry. And then we are just looking for prior levels. Stop loss above the high. If you were to take that conservative entry, putting your stop loss up here is pretty far away. So you probably would have had to put it just above that level that is being swept. Okay? All right, let's look at a few more examples. So that was a bearish example. Here is a bullish example. So this candle's low. You can see this red candle right here. Very strong downtrend. This candle's low closes, and it makes it look like you're going to continue that downtrend. The next candle, the breakout traders try to continue that downtrend, but once again, they fail to close below that level. So as it retraces the level, you can take a long there, or you can take a long on the 30-minute close. And once again, you target prior levels, whatever you like to target, as long as you are getting at least 1.5 times your risk. Okay? If you're risking 10 points, you want to be getting 15. So stop loss would be below the low of the wick, or if it's too far, you can put it below the level that is being swept. Right? If you guys enjoy this content, make sure to subscribe, like the video, We've got a few more examples for you here. Okay, here's another one. Very strong uptrend. Candle closes. You break through it. It sweeps back below it. Okay? So remember, you have the level. You break the level. You retrace the level. So on that retrace, that is where you're looking to enter. So there's the level. We break above it. We trap those breakout buyers. We enter short when it retraces below that level. And then all those breakout buyers start to get squeezed out. They trigger their stop losses, which helps our scalp. All right, a few more examples here. So this is an example of one that doesn't completely change the trend. The same thing here. This is actually a double sweep. It's sweeping both sides of the candle. So depending on how that ended up playing out, you probably could have scalped both sides of that. But for the example here, this is a bullish example. So we break the low of the candle to the downside. It goes back above that low. You can buy the retrace. Stop loss below the low. And then target prior levels. All right, I'm going to do these last ones a little bit faster. You guys probably get the idea now. So prior candles high, we break through that high, so the buyers are being trapped. We take that as a short entry on the retrace back down. So once again, level, we break it, we fail to close, we go back down. We take the short entry on the way back down. Stop loss above the high, targeting prior levels. Here's another really good one. Breaks the low, retraces it. Breakout sellers are trapped. Breakout sellers are getting squeezed. Their stop losses are being triggered. We would have entered around here. Stop loss below the low, targeting prior levels. Here's a short entry. Breaks the prior candle's high, retraces back below it, take the short, stop loss above the high, targeting prior levels. Here's another long entry. This candle closes here. Sellers are trapped below that level. You retrace the level, stop loss below the low, target prior levels. Here is another long entry here. Prior candle's low is taken. Sellers are trapped on the low. You can take that as an entry there, or you can wait for the candle close. Either way, targeting prior levels. Okay? So long story short, you need to look for where a candle is closing. Let's say this is a candle here. The candle's, where a candle's high is. So in this case, the high is right there. Let's say the next candle breaks that high, but it fails to close above that high. So you break it, you come back down, and let's say you close down here. This is a short entry because we broke that candle's high and we retraced back below it, trapping the breakout buyers. The entire idea behind this trade is trapping breakout traders. So if you guys have been those breakout traders where you trade the break of a level and you're like, okay, this is going to be a great trade, and then it goes against you right away. That is who we are trading against, okay? So you don't want to be the guy who's getting trapped. You want to be the guy making money off the people who are being trapped. All right? So the long entry would look like this. We have a candle down. Let's say the low is there. We try to break that low, but then we retrace back above it. Let's say we close up here. When we retrace back above that level, that is an entry, or you can take the entry on the close. targeting prior levels. Okay? It's all about trapping the breakout traders and making sure you are not one of those breakout traders that is getting trapped. But all right, guys, that is it for this video. I hope you guys enjoyed. If you guys have any questions, I know this is kind of a confusing pattern. If you have any questions, put them in the comments, and I'll get to them as soon as possible. I'll see you guys in the next one. Peace.